Let's bring in Eric Jackson, founder and portfolio manager of EMJ Capital, who I don't think owns Netflix, EJ, in part because you did anticipate sub-growth being a problem.
Hey, Carl. I haven't owned it since pre-pandemic. I think it was the first time they hit $400. At that point, I really felt like sub-growth was going to be their biggest issue moving forward. Yes, they have the option of doing price hikes until the end of time, or launching new services like games, which I think is still probably years away from being a reality. So, now we're in this situation where guiding to, 2 million negative subs next quarter is really tough. I mean, it would not surprise me at all if Carl came in, or Jim Cramer came in tomorrow, Carl, and said it's time to officially retire Netflix from fame.
Oh. Do you think this is an issue that they can price their way out of?
I don't think so. I mean, they have to raise prices to really continue to work as a story for investors. So you're not going to price cut your way out of this problem. Therefore, you're going to have to continue to invest in content. That's going to present all the international challenges that some of your previous guests mentioned. So I think they do streaming better than anyone else. They have that going for them. They're going to be a must-have for most people as part of their streaming options. But it's just a question of where are the incremental subs going to come. It's going to have to be from international, and they're going to have to probably hang their hat on that going forward.
All right. As for Disney and Warner Brothers Discovery, of course, and our parent Comcast, is this a warning or an opportunity, do you think?
It's probably more of a warning to most of those players, with some exceptions, and Comcast might be one of those exceptions, that this is just a really tough, long road that they've signed up for. And I think with some of the smaller players, I think Paramount, it's probably, the writing's on the wall, I think, with a report like this, that you're probably going to have to team up with a Discovery, HBO or something like that to have a hope of making it through this.
Yeah. Eric, as for the broader market, you do have a lot of ideas about nuclear, about batteries and EVs. You think the notion of a famine in the fall is underappreciated. What's the most constructive theme you're putting together right now?
Well, it's really going to be a hit and miss market, as we saw with Netflix today. I mean, I think there are some tech stocks that have been decimated that are going to surprise to the upside with really positive reports in this quarter and quarters to come this year. So I'm personally long Opendoor, part of the fund. I think they've been decimated, down 67% in 5 months. People are bearish on housing. They're bearish that that housing stocks will ever work. We had a rally today, by the way. But here's a stock in Opendoor that's got a service that's needed. They are making money and incrementally more money every quarter. And, if they're trading at 0.3 times sales, down from like 1.7 times sales, when times were better. So if they can surprise to the upside and go back to like a one-time sales, talking about a stock that goes from $8 to $35. Some of the other names, though, I guess the commonality is that Russia and the war in Ukraine have really changed the world for long term, and I think you really want to focus on agri-tech that's going to help grow food faster. You're going to focus on energy independence. I think nuclear is a really compelling story in the long term. That people like Elon Musk and Mark Andreessen are pounding the table for. And there are a few names out there that are really not institutionally owned. And these stocks tend to have 3-year run-ups, not just sort of 6 weeks and then they're done. So I think there's still opportunity with a lot of them.
Always good to get your take. Appreciate you being there to bounce Netflix off of as well, Eric. See you next time.